Thanks for joining us today on Market Call. I'm Morella Fernandez. David Burrows will be with us on the show. Chairman and CEO at Barometer Capital Management. He'll take your questions on North American large caps. And here is how to reach us today. Call us toll free at 1-855-326-6266. You can also send your questions for David to market call, at BNNBloomberg.ca. Going to start here with a quick market check and see where we are so far on the day. Remember, we had record closes yesterday for both the TSX, the S&P, and actually the NASDAQ as well. But all are in the red to start the day today. So the TSX down 182 points, about 0.5%. There's some gains on energy, but miners seem to be losing today in Toronto. The S&P down 41 points, or about 0.6% so far in the day. And then the NASDAQ composite down 215 points, up 0.8%. All had been rallying, of course, lately on AI tech stocks doing really well. Earnings reports coming out that were strong. But there's always that overriding concern about inflation and oil. Oil, last time we looked, was just still under $100, with things constantly changing in the U.S. and Iran conflict. So West Texas Intermediate, this is the July contract. It is up 2.4%, we'll say, or $2.22, so 95.98. So again, still under the $100 mark, which it has been for a little bit of time. But there are concerns that oil will continue to stay higher, even if the Strait of Hormuz does reopen, because it'll take a long time for things to get back to normal, for the Strait to reopen, to be cleared of any dangers, and for any infrastructure damage to be fixed, as well as the backup of tankers in the area, which could be a problem as well. Sault Ste. Marie, Ontario is looking for solutions to fight back against U.S. tariffs. It's home to Algoma Steel, of course, a big steel maker in the country. CTV's Adrian Gabriel has more.
Along the shore of the St. Mary's River sits a northern Ontario city that's been propped up by the steel industry for more than a century. Though in recent months, the foundation of Sault Ste. Marie's economy has been forced to bend, though it hasn't broken just yet.
It's bent, and it's bent pretty sharply.
50% U.S. tariffs forced the city's largest employer, Algoma Steel, to accelerate their plans to pivot to electric steel making. In December, the company announced roughly 1,000 workers would lose their jobs, the largest layoff in Algoma's more than 125-year history.
Here in Sault Ste. Marie, the local economy is already struggling. Here on this main strip, the theater's been boarded up, same with appliance stores and laundromats, and there's a fear that the layoffs at Algoma might make matters even worse.
The huge impact will be when EI starts running out.
Michael DePratt spent 56 years at Algoma Steel. He now represents more than 1,200 workers as union president.
You believe diversifying from the U.S. is the only way forward for Algoma Steel.
We need to develop our own economy, right? We can't be vassals of the United States.
South Korean shipbuilder Hanwha has pledged to invest in Algoma and use the company's steel to manufacture new armored vehicles in Canada, if the bid is selected by Ottawa to deliver 12 new submarines for the Canadian Navy.
Frankly, we think that the bid that benefits our community is the bid that should be selected.
There are other potential bright spots in the Sioux's steel industry.
We're fighting back.
A joint $300 million public-private investment across town will see Tenaris expand its steel pipe production and add to its 800-person workforce.
For Tenaris, it's all about doubling down on domestic production.
We are devoting more and more of our domestic production for Canada. So our exposure to the tariffs is going down to the extent that hopefully in a couple of months it will be going almost down to zero.
With steely determination, those who call Sault Ste. Marie home are pressing forward.
The investments here at Tenaris will create 200 new jobs and hundreds of other spin-off positions over the next 3 years. Good news for a resilient steel city. Adrian Gabriel, CTV News, Sault Ste. Marie.
All right, a quick break, but David Burrows will join us. He's with Barometer Capital Management. He joins us after the break to take your questions on North American large caps. We're back in just a moment. Welcome back to Market Call. David Burrows of Barometer Capital Management is joining us today to take your questions. David, good to see you.
Great to see you.
Let's talk a little bit about where your focus is these days. Is it more on AI equities? Is it more on inflation hit sectors? What are you looking at?
Yeah, look, I think that everybody has their eye on what's going on in AI. It's a major transformation, and there's obviously enormous potential. Valuations aren't lost on anyone. They're very high, and the market is quite concentrated in these stocks. So we're there. But that being said, we're in a market where there are other leadership themes, and most of them are sectors that either benefit or provide a hedge against inflation that have been performing well. Things that would be more disinflationary or reflect economic weakness really are nowhere to be seen. So it's a have and have not market. And I think it's a market that you can be targeted and diversified in while being involved in the AI trade.
Yeah, everybody wants to be in on that trade. Let's start with an email right now as far as questions go from Sophia. She says, what does the guest think about BlackBerry? As you know, David, BlackBerry has been trying to do a bit of a turnaround. They said they've turned the corner in their last earnings, and people have been buying into that. Stock has been up. Do you like BlackBerry? Would you put money in?
Yeah, look, I mean, the technical situation, has been really positive from a trading perspective. It made a turn higher in kind of March, and it's been marching higher ever since. People, I think, don't understand the importance that BlackBerry's software has in applications that can't afford to fail. And so their platform has really been well utilized by the automotive industry because cars are becoming more and more sophisticated and smarter. And BlackBerry's been important in that role. So, the stock has extended. It's had a massive run. It's run from sort of $3 to $10 over the last short while. It's obviously a very different company than people remember it as being. But it's the company's generating cash, and certainly they're generating some growth. And if you look at the basing that the chart went through, when it eventually broke out kind of around $6-7, it's been on a tear ever since. So it's one of the more speculative plays, but I can understand why people are interested. It's it's a $6 billion market cap, and it's in an important growing area.
Okay, let's go to the phone line then. We have Gordon on the line. He's in Victoria, BC, with a question. Gordon, go ahead.
Good morning. I hold Brookfield Renewables, and I'm up quite a bit. Problem that I have is that the constant shuffling of assets that goes on with Brookfield, going back to the Edinburgh Brascan days, and the fact that the distribution isn't covered by the free cash flow. It's a lot of it is the recycling of assets, which I don't really like that model. Should I harvest my profits and move on?
Thank you for the question.
So let's just start. I mean, the renewable space and the clean energy space is having a really nice run so far in 2026. If you look at the ICLN ETF, which includes companies like Brookfield Renewable, it's performing remarkably well. Well outperforming carbon-based energy. Strong group. Within the group, wind and solar companies doing particularly well. I share your concern about sort of the lack of transparency in the way that transactions take place inside Brookfield Renewable. When they reported most recently, they did disappoint a little bit on the revenue side. So you got to keep that in mind. But they are growing very nicely. And they have a very strong liquidity position. They've got close to $5 billion in liquidity. This is a space that people are interested in, and certainly there's no shortage of demand for power. So it may not be my number one choice in the space. I actually own the ICLN, which gives me a basket. But I wouldn't say don't buy it. It's in a strong space and well capitalized.
Okay, let's move on to the next caller, Paul in Edmonton with a question. Paul, go ahead.
Hello. Yes, I own some ARC Resources. Do you think we should sell it here today at today's price? And if so, do you have any recommendations about where we should place the proceeds?
Thank you for the question. So ARC Resources, David, being bought by Shell. People have been asking, do we get out before that happens or should we hang on? What's usually better?
Yeah, look, the energy, we like energy. We have about 17% of firm-wide assets in energy. We own largely large cap names. We own Suncor and CNQ and Imperial. We own a couple other names, one I'll talk about today. There's some safety in the arbitrage waiting for Shell, but I think that I would move on. There's not much more upside in it, I don't think. And I think that you probably could be repositioning. And I'll give you an idea today.
That would be in Top Picks, which is coming up later. Let's take a quick break. David Burrows staying with us. He's with Barometer Capital Management to take your questions on North American large caps. Back in a moment. Welcome back to Market Call. William is on the line. He's in London, Ontario. He has a question today for David. William, go ahead.
Good afternoon. I've done very well with Enbridge, and I'm thinking of selling it and buying something else. What would you suggest? Keep Enbridge or buy something else? And what would that something else be?
All right, David Burrows, it feels like people want you to give up your top picks early, but what are you thinking about whether to hold Enbridge?
Look, we like Enbridge. It's performing really well. We think that this is a great business that they're in. It's an incredibly strong management team. They're very disciplined in the metrics that they follow and in the investments that they make. You're getting paid a 5% yield. The only negative I would say is, in general, high dividend paying, lower growth securities are not leading this market. Enbridge, is a bit of an anomaly in its space. But from a risk-reward perspective, we like it. We own it, and we've owned it for a while. And yeah, it's up a bunch. But I think that the energy sector is relatively early on in a longer-term bull phase, and I think that you get some inflation protection, you get a nice yield, and total return should be pretty darn good.
Okay. Let's go to an email then from Jazz. Your thoughts on MDA? Is the present price a good entry point? I haven't looked at MDA space for a while. It's been up and down, but has done well, I know, in the last month or two. So let's have a look at where it lands today. It's at 56.29. It has a bit of a run up here since the end of last year. David, would you put new money in today for MDA space?
Yeah, so we think that, the space industry is very early days. And MDA is a way that you can participate, through the Canadian market. It has been prone to some disappointments, and it was more around, what happened in some of the satellite contracts due to M&A. We like it. I think that the risk is that we have this giant IPO coming in SpaceX, and of course, there's a lot of euphoria around the group. But there have been 20 space ETFs launched, and they're all going to need positions outside of SpaceX. And so the demand side is probably pretty strong here. So as a proxy on the group, I have no problem owning the stock.
Just to further that question, because as you mentioned, SpaceX is going to gobble up so much of the energy in that space and the interest in that space, would MDA Space, a company like that, sort of benefit from the overall mood of investors who want to get in on the space, or would it sort of go the other way just because all of the attention and energy is on SpaceX?
Yeah, so if you think about it, those people that are buying the space-based ETFs to get exposure are creating demand for other companies in the group. It's unlikely that anybody is going to raise enough money from the small companies that are there already to fund purchases of SpaceX. I think it's more likely that they're going to be taking money from other mega cap technology companies, and money will funnel into the ETFs that then, by nature, will create demand for other companies in the space industry ecosystem.
Okay, so could float up. Let's go to our next caller then. Ron's on the line. He's in Calgary. Ron, go ahead.
Yes, hi. I'm calling Thanks for taking my call. I'm calling about Fairfax Financial, and they own a little bit of BlackBerry, about 25 million shares right now, but they have been selling it recently. But they said that they're going to hold with what they have right now. But I know it's mainly an insurance play, and it's a lot like Berkshire Hathaway in that respect. Could you give me any thoughts on it?
Okay, thank you for the question, David. Go ahead.
So for folks that have watched over time, I like to highlight that between 70 and 80% of return that comes in an equity comes from being in the right neighborhood. And you can have a great house in a bad neighborhood and not make money. We think Fairfax is a great business. In fact, we owned it for years until we came out of it a few months ago. The truth is, though, that property and casualty companies have been under pressure for 2-3 years. Premiums were very hard, meaning they were able to put through pretty significant price increases on policies. And that is less the case currently. They're also an investment vehicle, and Fairfax has done a great job in managing their investments, and you're referencing that with BlackBerry. But right now, you have a sector that's under pressure, and virtually everybody is under some pressure. Berkshire's under some pressure. Progressive's under pressure. So I think it's just not the right time to be adding a position here.
Let's move on to the next caller then. Frank is in St. John's, Newfoundland. Frank, go ahead. Frank, are you there? Okay, I think we may have lost Frank, but I think his question was about Atkins Realis. I'm going to pinch it here. Atkins Realis has been sort of going sideways, if anything, and I think there was expectation that this stock would do much better in the climate where there's going to be build out in Canada and other countries in the world for AI, and that this is a company that would benefit from that. As you can see, the stock is quite down over sort of last month of May. Is there anything weighing on Atkins Realis that you see, David?
Yeah, look, in general, some of the engineering companies have been under pressure. They had a tremendous run. I mean, Atkins Realis ran from $20 to $110, so it was up 5 times over the course of sort of 22 through 26. So it makes some sense that it's resting, and the group is resting, frankly. Relative strength started to weaken in June of last year, and it's basically traded about as well as the bottom 19% of stocks in the S&P. So it's a laggard. When you're in a bull market, you want to take advantage of it. You want to own things people really care about. We're trying to be very, very selective and carve out underperformers quickly, frankly, because in a midterm election year, you tend to have weakness in June, July, and August. And we'll see whether that happens or not. And right now, the market breadth is not ideal. So we're trying to be very, very cautious. So I don't think that this is one I would be purchasing currently. I think I'd wait for a better opportunity.
Well, let's get to a quick break then. We will come back with past picks from David Burrows in just a moment. Welcome back to Market Call. We have past picks from David Burrows from July 17th of last year. And at the time, David, you chose GE Aerospace, or GE in New York. It was $260.28 US at the time to $313.68 today, 21% upside, a total return of 21%. What's been working well for GE Aerospace?
Look, first of all, the aerospace sector, for obvious reasons, has been performing really, really well. GE Aerospace, benefits 2 ways. One, they sell engines, and of course, they sell maintenance. And for a long time, the next generation of engine was delayed, and that caused increased maintenance, and GE's been a beneficiary there. So there's obviously a lot of demand for jets. GE has great exposure across the spectrum. They're getting great recurring revenue from the maintenance business. And we've had a fair bit of exposure through that sector, including Howmet Aerospace, which I've used as a top pick along the way as well. And now in the last couple of months, the defense stocks have come off a little bit. They've had a tremendous run. They're consolidating, but I like this business. It's a dominant global business and has a great opportunity for cash flow and earnings growth.
GE Aerospace. Let's get to your next past pick from July of last year. Agnico Eagle, AEM on the TSX. Was 118.61 at the time, now to 173.57, so 46% upside, 48% total return. Can I ask you, in a sort of wider lens, where you're landing on gold these days? I imagine you've held on to Agnico.
Yeah, so our long-term thesis is that we started a commodity bull market 3 years ago, and that's based on the fact that we're in a more inflationary world, and these companies can generate really extraordinary cash flow and return capital to shareholders. Agnico is the cream of the crop. Now, in January this year, we got into a parabolic increase, a very sharp increase where things got very extended, and we actually carved back our weightings, expecting a 3 to 5 month correction. If you look at previous gold bull markets, they tend to come in stages. They tend to go on for a decade. So my sense is we are now sort of 3 to 4 months into what will be, sort of 3 to 5 months of consolidation. We've come down to the long-term moving averages, and we are, rebuilding our weight in precious metals. I'm not sure that we're completely done that work. So for an investor who is a long-term investor, I would just buy it and hold it. We did come off of quite a lot of our position overall in precious metals, and we've been rebuilding recently, and we'll continue to over the next, month or 6 weeks. But this is the first inning, or maybe the first 2 or 3 innings of a 9-inning game, and the next leg should be a very strong leg higher as well. And this sector is not well owned. Really, none of the basic materials are well owned. They're a very small part of the S&P. And so, a lot of investors think they're irrelevant, but they have the characteristics for exactly what we're looking for. These companies are going to generate really nice dividend growth over the next number of years. There are going to be a lot of share buybacks. And the sector is small, so demand makes a difference. As people build positions, I think prices move higher.
Let's get to your last pick from last year in the energy space, Imperial Oil, IMO on the TSX. 112.63 at the time to 176.17, 56% upside, 58% total return. How much of this has come over the last 3 months with what is going on in the Middle East?
Yeah, it's obviously benefiting. When we bought it, it was that many of the very large cap, long life asset companies were breaking out of sort of 10-year periods of consolidation, and it entered new bull markets. Again, it'll go on for years in our opinion. And the Canadian companies were trading at a discount. That discount is starting to come out. There's international interest in Canadian companies. It's obviously benefiting from what's going on in the Gulf. But I think for those that think that if the Straits of Hormuz gets solved and the energy goes right back to where it was, I think that's just not reality. Countries that didn't have a reserve are going to need to build a reserve. Countries that reduce their reserves and put them into the market are going to have to replace, and there's going to be a premium for risk. So, there is near-term news risk on some kind of a deal. I would fade that. I'd be a buyer of Imperial. I'd be a buyer of CNQ. I'd be a buyer of Suncor. Again, you're going to hear a lot of these characteristics. We want companies that generate lots of cash, that don't need a lot of debt, that have a willingness to return capital to shareholders. That's the kind of profile that will help offset inflation.
Let's take a quick break on that note. David Burrows will be back to answer your questions in just a moment. Welcome back to Market Call. Kevin's on the line. He's in Kingston, Ontario, with a question. Kevin, go ahead.
Hi, David. Thank you for taking my call. I watch BNN quite a bit, and I enjoy when you are on. Can you please tell me about Visa and MasterCard? They're both in the same business. I've been invested in both of them for almost since their IPOs, but the last 2 years, their charts are horrible. I've never seen their charts like that since they went public in 06 and 08. And there's something wrong with Visa and MasterCard, and I thought I would never say that. Thank you.
Thank you for the question. Kevin, what's weighing on these stocks? Is it sort of digital payments?
Yeah, so Kevin, it's a great question you ask. I think a lot of people are questioning. These have been unassailable fortresses for a long, long time. I mean, really, right from the IPO, Visa was just a dynamo, and we owned it for a long time. It's interesting. I do a webcast each week, and we've talked a little bit about the weakness in the XLF, which is the broad-based financials index or ETF in the U.S. And, you know, it's a very mixed bag. And in particular, the card companies and fintech stocks have been weak, along with some of the insurance stocks. And I think it has to do with the concern around disintermediation with digital payment systems. There's obviously, you know, they have had a real fortress around the interchange fees that they charge. And, you know, there is innovation to try and dislocate some of that. So in the near term, it creates some uncertainty about, you know, the long-term profitability. Now, I think that they have a pretty dominant position, and the consumer is certainly not shy about using credit cards. But in the near term, I think that basically they're consolidating strength. I mean, Visa ran up from December of 22 from $175 to $375, I think, at the peak. So it's off sort of $60 or $65 off the high. It's still trading above a long-term moving average. It's just lagging in this market. And if you think about inflation protection, it's not that well inflation protected. So it's hard for them to put prices up. You know, supposedly they were going to all volunteer to drop the interest rate on the cards, and that's obviously not happening at the bank level. So I just think there's other places to focus.
Let's move on to an email then, David. This is from Long. He says, would your guest outline his views on Lumen as a long-term hold? What can you tell me about Lumen?
Yeah, so I have to be honest. I don't spend a lot of time on Lumen. So I'm going to sort of step aside on this one. I apologize.
Sure.
It's not one I can give a good answer on.
Okay, let's get to the next caller then. Frida is on the line. She's in Chilliwack. Frida, go ahead.
Hi there. I'm interested in Athabasca Oil and your opinion, as it has long reserves and a good future for Canada. What do you think?
Okay, thank you for the question. Go ahead.
Well, as I mentioned earlier, we really like the oil sands companies. We think that they're in the process of being revalued positively, which means, you know, as the earnings grow and the cash flow grows, if the multiple that investors are prepared to pay is growing at the same time, that's what makes a bull market. And these companies are all growing their revenues. All of these companies, including Athabasca, are returning capital to their shareholders. Athabasca is committed to return 100% of its free cash flow back to investors. So I think it's a very interesting company. I mean, they're reducing the share count. They're increasing their production. They're on schedule to hit 40,000 barrels a day by late 2027. It's a little bit more aggressive way to play the oil sands. Stock's behaving really well, and I think it's a good way to participate.
All right, that was for Frida. Let's get to one last caller in the block. John on the line in Oshawa, Ontario. John, go ahead.
Well, hi, Mariel, and thank you for taking my call. Mr. Burrows, welcome back with stellar reports on the previous picks. Thank you. My question is on Microsoft. Is it still in the limbo, or is it now on the way for better earnings as we look at the next couple of quarters? headquarters and beyond. Thank you. Thank you.
Thanks, John. Microsoft Meg 7, where are you landing on Microsoft, which is kind of lagged behind some of the others? Is that still on software concern, David?
Yeah, we have really no software exposure. Our exposure, and to put it in context, we're about 13% technology across the firm, and that's obviously a significant underweight. So we're really targeted right now, and we do own NVIDIA, and we do own Lam Research, and I think you have to pick your spots. We look at the semis as the equivalent of copper and what copper has represented over time as a call on the economy, right? And it's an inflation asset because as demand is strong, and strengthens, you can put your prices up tomorrow, defend a great margin, and have inflation protection. The software companies, I think, are in a trickier spot because some of their businesses may be under some pressure going forward with agentic AI to rate software. They're not going to replace Microsoft. But the truth is they become consumers of capital. They're investing, significantly in infrastructure to support AI. And so they're going to return a little bit less cash to shareholders, maybe dividend growth a little bit less, maybe share buybacks a little bit less. And while they've had a bounce, all the software stocks over the last couple of months, the charts aren't that great. Relative strength for Microsoft is traded better than only 30% of stocks in the S&P over the last 52 weeks. We're just staying clear of software for now.
All right, let's take a quick break, David. We will be back with more phone calls and emails in just a moment. Stay tuned. Welcome back to Market Call. David Burrows with us today to answer your questions. Jeff has written in. He says, I would like to hear David's thoughts on Cheniere Energy, LNG producer in the U.S. Thanks. Do you know much about Cheniere Energy? I know they're out of Texas. What else can you tell us about them?
So Cheniere really are the company in the transshipment of liquefied natural gas. And they're a big beneficiary of demand coming from the rest of the world. They're able to buy gas at North American prices and liquefy it and sell it on the international stage. Obviously, given what's going on in the world energy markets, they've had a pretty good geopolitical tailwind in their business. But this is a growth business, and it's going to go on a while because we have lots and lots of gas in North America, and a lot of it's trapped. And so they can create value by liquefying it and getting it out. In the first quarter, they had like 200 cargo ships, 187 cargo ships export out of Corpus Christi, and they're going to continue to grow their capacity. The risk, I mean, it's a very capital intensive business. So I think that they are investing a lot of money, and that's if the cost of capital goes up, that could be a headwind. In other words, if long-term interest rates go up, that could be a headwind. But we like the business. If there's some kind of a settlement in the Straits, immediately you could see a negative psychological impact on the stock. But technically, it's behaved really well. It's pulled back a little bit recently from 300, so it's down kind of 20% off the highs, but basically trading above the 50-day moving average, which is rising. So we like it as long-term energy infrastructure.
That was for, I just missed the name here. That was for Jeff.
Cheniere
All right.
Energy.
Okay, let's go to Jacob. Jacob's on the line in Toronto. Jacob, go ahead.
Hello, good afternoon. Hi, can I ask your guest about alimentation couche? It seems not going anywhere, and just to know if add to it or just stay put with it. Do you also own it in your portfolio? Thank you very much, and have a nice afternoon.
Thank you for the question. Couche-Tard has been really just going sideways for quite some time since its attempts to buy 7-Eleven in Japan. Have you invested in Couche-Tard, or is it one you have invested in the past?
Yeah, we've been asked a lot of times over the last couple of years. This is a stock we owned for a long time, and when they stepped up to make a bid for the 7-Eleven stores, I said actually on this show, if they were able to complete it, we would buy the stock in a heartbeat because they are really, really good at acquiring and integrating. And that would give them a long runway for cost improvements and revenue improvements across the system. As it is, they haven't had anything significant since then. They are growing their revenues mostly recently because fuel prices have been higher. The consumer is not spending more money in the existing stores. They are excellent operators, but we in general have stayed away from the consumer. The consumer is the downside in the inflation environment. Unless you have something really special, and we own Aritzia, for instance. I think it's our only consumer investment because they have something that's special and they can expand geographically and so on. Until there's some other catalyst for Couche-Tard, it's less interesting to us because it's hard to see multiple expansion unless you have some kind of a major shift.
Let's go to the next caller then. Jerry's on the line in Toronto. Jerry, go ahead.
Yeah, hi, Morella and David. My question today is on CGI. I've held it for a very, very long time, seen it go from pretty low levels to very high levels and then right back again. Just wondering what your opinion is of it at this time. Do you own it, or do you think I'd be better off selling it and going somewhere else?
Okay, thank you for the question. Consulting, information technology, we touched a little bit on this, David, but CGI more specifically?
Yeah, I mean, look, they have a tremendous amount of money, a number of projects with government in the U.S. and with Canada and in Central Europe. It's been a great company over time. Earnings growth has been slowing. And so if the estimate for 26 is like 20% earnings growth, 27 is 9% earnings growth. So when a company has been a grower for a long period of time and growth seems to be slowing, that's when you get multiple compression. So that's the other side of revaluation. You get earnings growth, but multiple compression, or you pay a lower number of times earnings, price can move lower. And so technically the stock is a bit broken. I just think that there are other places that I would focus the capital in right now. You're in a bull market in technology. You got a technology company that's performing poorly, and not just like for the last couple of months, but like for the last year. I think there's other things to do.
Let's quickly get to Ron out of Edmonton with this question. Ron, go ahead.
Oh, thanks for taking my call, David. I got a tip on Algoma Steel, and I've been adding to it slowly. And I'm wondering where you see the risks, the future catalysts, and Kuzma tariffs, and do you think it'll get back to its all-time highs?
Okay, thank you for the question, Ron. That's a difficult one. There's stuff simmering, we'll say, with Algoma. However, do you think it could recapture what it was?
Well, look, go back to my original thesis. If 70% or 80% is the sector, the sector has a tailwind. If you look at the SLX ETF, and maybe you can put it on the screen, made a new all-time high yesterday. And the steel sector on a long-term basis started making new highs about 18 months ago and, is performing really well. Algoma, of course, is a special situation, and it's improved recently. Stocks moved up from kind of $4 and change to just about $8. So, they're trying to turn things around there. I'm not a big fan of turnarounds. I'd rather buy the strength in the group. So, if you look at Nucor, for instance, Nucor only about 5-6 weeks ago made a new all-time high, and they're about the lowest cost producer. And, I just think a better business. So I would prefer to stay away from turnarounds. Algoma Steel has been burning cash, and until that starts to change, I think I would stay away.
All right, let's take a quick break. We're going to come back with some new picks from David Burrows in a moment. Stay tuned. Join us tomorrow for Market Call. Darren Sissons will be on the show. Partner Portfolio Manager Campbell Lee and Ross Investment Management taking your questions on global and technology stocks. That is tomorrow. Let's get to some new top picks from David Burrows. We're going to start with Bombardier, BBD.B on the TSX. What do you like about Bombardier in the future?
Well, let's start with the fact that it's in the right industry. Aerospace is a great and growing industry with large business opportunities. We don't like to buy turnaround situations. We like to buy companies that are good getting better, where there are catalysts for positive change. So they already went through a period where they paid down debt and became really a pure play business jet leader. Now has a dynamite balance sheet, and all that's fully reflected in the financials. So it's not that it's a turnaround; it's that their businesses really are lifting. And, jet delivery growth is strong. Their margins are expanding. They have a lot of optionality given their strong balance sheet. And to give you an idea, their book to bill, in other words, their new order book, grew 43% over the past year. Their book to bill was 3.6 times. So for every dollar they delivered, they got $3.6 in new orders. So that's solid. They had a 25% year over year increase in their services. And they're going to generate $1 billion in cash in 2026. So they're winning. Now, for future catalysts, it looks like they'll get an order from NATO for 10 to 12 GlobalEye aircraft, which are being used for sort of airborne early warning. They got an order from the Canadian government of Canada on the same plane. So we think that there's a lot of things that can add to the story as we go along, and the multiple can continue to expand alongside it.
Okay, let's get to your next pick, which is BHP Group. BHP out of New York. I think I remember you recommending this once before. What do you like about BHP, or what do you still like about it?
Yeah, so we like cash-generating resource producers because they are great from an inflation protection perspective. They've all gone through major deleveraging and taken debt down on their balance sheets. BHP is the largest producer of iron ore on the planet. Roughly 45% of their revenues comes from iron ore. And the reason it's only 45% is they've been taking their excess cash and adding copper production. So their copper production was up 28% over the last 3 years and is now 44% of revenue. So a lot of the iron ore is produced in Australia, gets sold into Asia. They are fully integrated. They own the mines, the rails that they ship on, the ports that they ship out of. So it's a very integrated, diversified, basic materials producer that will be a great dividend payer and will be great at returning capital to shareholders. And if there's inflation, we're going to benefit from it.
Let's quickly get to your last pick then, which is beat on energy, Tamarack Valley Energy, TVE, on the TSX. You've talked during the show about how much you like energy right now. What is it about Tamarack Valley specifically that you're looking at?
So outside of the large oil sands companies that we own, and we're not really going down the quality scale. We're staying right with the highest quality. We do have exposure to a couple of companies in the Clearwater, companies that are using water flood technology to pick up their production. And Tamarack Valley is generating great growth in production. They're expecting about 15% production growth in the next half, and expanding water flood. They're looking for 60,000 barrels a day by year end. And that means that they're generating a lot of cash. So, they're going to continue to increase their dividend. They just recently increased their dividend by 25%. They're increasing their share buybacks. Again, international investors are coming back to Canada for some of our energy companies, and we think we can see multiple expansion along with pricing power.
All right, David Burrows, good to see you, sir. Thanks for joining us today.
Thanks for having me, Marilla.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.